As back to our top story tonight, China appears to be feeling the heat from its ongoing trade war with the United States. The country's economy grew just 6% in the third quarter compared to last year, and that is the slowest pace of growth in nearly 30 years. But the trade war isn't the only factor to blame. China is also struggling with faltering domestic demand and a slowdown in manufacturing. Joining us to break down these numbers is Francis Lam. He is CEO of GEO Securities. Francis, what does the latest quarterly number tell us about China's economy? Are we at a new normal here of growth?
I think so, because China's growth actually been slowing down for the past few years, ever since 2008 and 9. You won't get 10% growth again, because China is a much more mature economy. It has migrated to the middle-level status, so it is illogical to expect 7 or 8%. Again, I don't think they will achieve that for quite some time. The fact is, after 2 trillion yuan in stimulus, they only be able to achieve 6% economic growth. That shows that actually the economy is slowing down much more rapidly, much more quickly than people expected. So for the whole year, I think it would have the planners would have done very well if they can achieve year to year 6% growth for the year. Even 5.9 is not bad at all. Just think US and Europe have economic growth of 2% only. So 6% is nothing to scoff at.
Certainly, Francis, I mean, some analysts feel that that 6% number could be even lower, but even so, it's still robust enough growth for the country. But there are many reasons why the economy is slowing in this way. One of the reasons and one of the things we've closely been looking at is this US-China trade war. Perhaps there'll be a deal. We're hoping there might be some kind of a deal. Do you think that if there is a good deal, it could help the economy at all?
Well, definitely, because one of the economic components that's slowing down very markedly over the last year is really trade and manufacturing. China trade actually declined, something like the imports declined by 8.5%. That is quite a big drop. And imports from the US fell something like 14%, and exports fell by something like 8%. So a lot of the brand owners, like clothing manufacturers and the handset brands, actually moved their production out of China already. So I think if there is a trade deal before the end of the year, they can stop this exodus of manufacturing. Otherwise, next year, it will be even more dire for the Chinese economy.
Francis, China is Singapore's largest export market. South Korea is significant as well for its export market to China. How is this weak growth data going to affect countries like South Korea and Singapore?
Well, it will affect the world, actually, adversely. Surprisingly, when you look at any single product, handset or clothing, whatever, it's not made in just one country. It's a chain of production that spread over several countries. The China and US trade war actually affected the economies of East Asia, from Japan to South Korea, Taiwan, Hong Kong, and Singapore. And it also affected the economies of Europe, because China's buying fewer machinery from Europe. So it's something that, well, except for Donald Trump, nobody is happy about. But Donald Trump is still very happy. He said that he's winning the trade war. But I don't think anybody else will agree with him.
He probably has very few people agreeing with him on that one. Francis, thank you very much for that perspective. That was Francis Lam there. He's CEO of GEO Securities in Hong Kong.